And is being billed as a massive tax cut by Republican lawmakers. But once the bill becomes law, who will actually benefit? Daniel Geltrude is a certified public accountant for Geltrude and Company. He joins me now to discuss some of the details in the bill. Dan, we're so happy to have you here because there's so much to unpack. There are so many details the American people are curious about. I'm personally curious about how this is going to affect me. So let's talk about, first of all, who are the biggest recipients of these tax cuts straight out of the gate?
By far, it's corporations. As you said, 35% down to 21. It's tremendous. And it's going to be an economic boost, though.
But so how will this impact the average American household? I know it's hard to look at an average American household because we're looking from state to state. We're looking at all kinds of different tax levels. But if you were to try to make it as broad as possible, how will this affect the average family?
The average family generally isn't using itemized deductions. So if they just have a standard deduction, which is now going to be doubled, and with the lowering of the tax brackets, those people are going to get a tax cut. So middle America is going to get a tax cut.
Right. But here's the fine print. Not everyone will get a tax cut, and some people will actually see their taxes go up. Who are those people?
So tax reform inherently picks winners and losers. So you want to talk about the losers? The losers are going to be those high income earners in high tax states. Why? Because they're losing the itemized deductions specifically for state and local income taxes and real estate taxes. That hurts.
And their taxes could go up by as much as tens of thousands of dollars.
No question about it.
Yeah. Okay.
So the big, beautiful tax gift or Christmas present becomes coal for some people.
Absolutely. All right. Now let's look at property taxes. How will this affect property taxes on the whole? For a lot of people, their main asset is their home. What will that mean?
I think in, again, high tax states, you're going to actually have a shift of home values. It's been estimated that New York, New Jersey, California, those types of states, Connecticut, you're going to see values go down by 10%. Whereas in Florida, Texas, Nevada, where taxes are very low, they're going to benefit with higher values of their property.
So if you're in one of these high tax states such as New York, New Jersey, California, and you're thinking of selling your house, sell it now before the new year.
You got 10 days.
You got 10 days. Oh boy. All right, well that's good to know. But in terms of the tax process, this is being touted as a more simplified tax process. Is that true?
The good news is, no, it's not for me as an accountant.
Right.
Because people are not going to be able to get rid of their tax preparers. Why? There's a few reasons. One, we still have 7 tax brackets, so there's no simplification related to the brackets. The alternative minimum tax, that's been put back in there for individuals. What does that mean? That means that 2 calculations of your taxes have to be done. The regular and the alternative minimum tax, so that you are paying at least a minimum amount of tax. So that dual calculation not going away keeps things complicated. Then the pass-through entities, the S corporations, LLCs, those rules are not so easy to interpret. So
your services, sir, will be very much in demand. But an interesting little caveat is that your services are now no longer tax deductible.
Yes, yes. So that's the bite on the taxpayer, that you still need me, but you don't get a tax deduction for me.
For using you. All right.
Yes.
What are some of the other little tax deductions that are being lost? I mean, for instance, a lot of corporations or companies used to subsidize their employees' transportation costs, but they probably won't going forward, correct?
Right, because it's not going to be deductible going forward. Then you have casualty losses. So if you have a fire in your home, this will be for 2019, whatever's not covered by insurance, no longer deductible. So those little things are going to pop up as, unfortunately, we experience them.
Yeah, they're so interesting, some of the details. Even if you work in the entertainment industry, for instance, you used to be able to deduct your agent's fees, your union fees. Those are no longer
deductible. Yes.
And like you said, a lot of the transportation, bicycles,
bicycle transportation. Yeah. How about this one, though? Alimony is no longer going to be deductible in 2019. So you got to plan your divorce right.
That's right. You either
got a year to plan it.
That's right. You've got to do it now or just stay married.
Right. You're stuck with it.
It makes even less financial sense to get divorced now than it ever did, right?
Right. Exactly.
That's an interesting point. Now, how can you prepare financially ahead of time? And we have a few days, until the end of the year.
We do have a few days. So there's a few things that you could always do. One, contribute as much as you can to your retirement plans, especially 401k. If you have your employer making contributions, matching contributions, that's a great idea. Make your charitable deductions now, because if you're not going to be able to itemize going forward or get the benefit, take that charitable deduction this year. And then there's some people, you have to look at it, you have to do the calculation to say, am I actually going to have more taxes next year or less? Yeah. And depending where that is, you may want to shift your income or your expenses accordingly.
So a lot to think about in the week ahead. Daniel Geltrude, thank you so much for joining us today. President Trump has issued a